Here's a fact that sounds like a conspiracy theory, except the Bank of England published it themselves. About 97% of the money in the modern economy was never printed by any government. It was created out of nothing by ordinary commercial banks the moment someone took out a loan. The money in your account right now was, quite literally, typed into existence. Let me show you how. This is the single most misunderstood machine in the entire economy. Once you see how it actually runs, inflation, debt, house prices, and the power of banks all stop being mysterious. So let's take the lid off. First, the story you were taught in school. It goes like this. A bank is basically a vault. Savers deposit their money. The bank keeps a little in reserve and lends the rest out to borrowers. In this picture, the bank is a middleman. It can only lend money that someone else first put in. It's simple, it's intuitive, and according to the people who actually run the monetary system, it is wrong. Here is what actually happens in the Bank of England's own words. The majority of money in the modern economy is created by commercial banks making loans. Read that again. Banks don't lend out money that exists. The act of lending is the act of creating the money. Loans don't come from deposits. Loans create deposits. Picture it concretely. You get approved for a $200,000 mortgage. You might imagine the bank shoveling $200,000 of other customers' savings across the counter. That's not what happens. The bank simply types $200,000 into your account. No vault is emptied. No saver loses access to a cent. Brand new money now exists that did not exist 1 second earlier. It was created by a keystroke. Now scale that single keystroke across an entire economy, millions of loans at once, mortgages, car loans, business credit, credit cards. Each one mints fresh money. Add it all up, and you get the staggering reality the Bank of England confirmed. Only around 3% of the money in the economy is physical cash, printed by the government. The other 97% is digital deposits, conjured by private banks making loans. At this point, every economics textbook raises its hand and objects. What about the money multiplier? Isn't there a strict limit? Banks can only create some fixed multiple of the reserves they hold. It's the most widely taught idea in monetary economics, and the Bank of England calls it a myth. The textbook says money creation starts with reserves. The central bank injects reserves, and banks multiply them up into a fixed, larger amount of loans. The real world runs the opposite direction. A bank makes a loan first, creating the deposit, and only then goes looking for whatever reserves it needs, borrowing them if it has to. Reserves don't limit lending in advance. They follow lending after the fact. The whole arrow points backwards. So if it isn't a reserve ratio, what actually stops banks from creating infinite money? Real constraints, just not the one you were taught. Profitability. Each loan has to be worth making. Risk. Borrowers can default, so banks lend carefully. Regulation. Capital rules limit how much banks can lend against their own funds. And competition for borrowers. Above all, the central bank's interest rate makes borrowing cheaper or costlier, throttling how much new money the system creates. This reframes what a central bank even is. It's not a vault handing out the money that banks then lend. Its main job is to set the price of money, the interest rate, and to keep the whole system stable. When the Federal Reserve or the Bank of England raises rates, they're not running out of money. They're making the creation of new money through borrowing more expensive on purpose. And here's the part that flips the whole thing into focus, the loop we opened earlier. If making a loan creates money out of nothing, then paying a loan back must do the reverse. It destroys money. When you repay that mortgage, the money you hand over doesn't get put in a vault for the next borrower. It simply vanishes from existence. The keystroke is undone. So the money supply is really a giant breathing lung. When people and businesses borrow more than they repay, New money floods in and the economy expands. When they repay more than they borrow, in a recession, when everyone's scared to take on debt, money is destroyed faster than it's created, and the supply actually shrinks. Money isn't a fixed pile. It's a tide that rises and falls with our collective appetite for debt. Sit with what that implies because it's uncomfortable. Almost all of our money is created as somebody's debt. If every loan in the world were repaid tomorrow, most of the money would simply disappear. The system needs a constant, growing pile of debt just to keep enough money in circulation to function. Money and debt aren't opposites. In this system, they are two sides of the exact same coin. There's one more player who can create money directly: the central bank itself. After the 2008 crash and again in 2020, banks stopped lending and the money supply threatened to collapse. So central banks did something extraordinary called quantitative easing. They created brand new reserves again, from nothing, and used them to buy up government bonds and other assets by the trillions, force-feeding money into the system to keep it alive. The numbers are almost hard to process. Through quantitative easing, the U.S. Federal Reserve's balance sheet ballooned from under $1 trillion before 2008 to a peak of roughly $9 trillion. Nearly $8 trillion summoned into existence with keystrokes to prop up the financial system. Money creation, which normally hides inside millions of quiet loans, was suddenly happening in the open on a historic scale. And this is where it touches your life directly. When money is created faster than the economy produces real goods and services, each dollar buys a little less. That's inflation, the silent tax we covered last time. And when new money floods into assets, stocks, and especially housing, it inflates their prices, which is one reason homes keep drifting out of reach. Money creation isn't abstract. It's in your rent and your grocery bill. So what actually transfers to you once you can see the machine? First, understand that saving cash alone is a slow leak because the money supply is designed to expand around you. Second, this is why owning assets matters. When new money is created, it tends to flow into things, lifting their prices. Third, debt is the engine of the money supply, so respect it, but understand the game is built to run on it. And fourth, nobody is fully in control, not even the central bank. That's the secret hiding in plain sight. Money isn't a fixed treasure dug out of the ground. It's a shared agreement, spoken into existence every time a bank makes a loan, and erased every time one is repaid. Understanding that doesn't make you cynical. It makes you literate in the one system that touches every single thing you'll ever do. Now you know where money really comes from. But there's a bigger question sitting on top of it. Who controls the institution that sets the price of all this money? Next week, we pull apart the Federal Reserve, who actually owns it, how it moves your rent from a marble building most people never think about, and why it might be the most powerful force in your financial life. Subscribe so you don't miss it, and I'll see you in the next one.